In this week's video, we'll review the latest charts and data to help us answer the question, weak breadth and inflation, overblown or concerning? We'll start with inflation because most likely weak market breadth has been caused by concerns about inflation. We covered this topic many times from a fundamental perspective. In recent years, we've shifted from a climate that was favorable relative to inflation to one that is significantly less favorable. Debt is a big part of that equation, and not a lot has changed relative to the bullet points or topics on your screen. The last major inflation scare in the stock market, this is November of 2021 up here. The red line is the performance of the triple Qs of the NASDAQ 100 ETF. From point A on November 19th, 2021 to point B in October of 2022, the triple Qs lost 35%. Thus, it's important that in the current environment, we don't get complacent and we don't fall asleep on inflation or for the potential of another 2022-like event. Chart on your screen, SCHG is in George relative to VTV. This is large cap U.S. growth stocks relative to large cap value stocks. We've got the ratio in black and we've got moving averages ranging from the 20-day in blue all the way out to the 250-day, the dotted black line on the bottom of your screen here. We all know the U.S. government was clogging up mailboxes with all of the checks that they were sending out in light of COVID. They wanted to make sure that they didn't repeat what they thought were the main errors in the wake of the financial crisis. They wanted to stimulate in a big way. And you can see, when we look at the ratio in 2020, they succeeded in a big way. However, we all know there's no such thing as a free lunch. Eventually, in the second half of 2020, some market participants started to become concerned about inflation. Let's call these the early adopters here. And you can see the growth relative to value ratio reversed sharply from this point in 2020 to this low here in 2021. And then there was a thought that maybe we'll be okay. And the ratio rallied sharply into late 2021. Unfortunately, that was not the case. Late in 2021, and especially early in 2022, after the S&P 500 peaked on January 3rd, 2022, now there was widespread recognition by market participants that inflation was going to be a problem. Early adoption over here becomes wide adoption in 2022, and that's how we get an ugly and painful bear market. And these two extremes on the right side of the screen and the left side of the screen give us an excellent reference point relative to the present day. This is what it looks like in an extreme manner when market participants believe that growth is the driver of the markets over inflation, and this is what it looks like when market participants believe inflation is the primary driver of the markets over growth. Eventually, all bad things must come to an end, and the fear of inflation started to recede really in Q4 of 2022, but the NASDAQ didn't bottom until very late in 2022, and growth started to outperform value again very, very early in 2023. If we move into early 2024, this final spike here was when semiconductors were leading and all of the AI hype was out there. The sentiment became very one-sided, and then in late June, early July, market participants started to get concerned potentially about inflation and valuations. Thus, if we fast forward to the present day, you can make a very rational argument that we're very, very close to completing a massive inverse head and shoulders pattern. Left shoulder is the early adoption concerns about inflation. The head is the wide adoption relative to the concerns about inflation. And it's not unusual, after a painful event like this, that we get some late adopters that start to get concerned that we're going to revert back to this type of market. And of course, that is entirely possible. But if we look at this chart objectively, it really doesn't support that thesis. Growth in recent weeks has significantly outperformed value. The chart on your screen is dated December 13th at 12:49 p.m. Eastern Time, just as you were finishing up your lunch. Compare and contrast the period here after January 3rd, 2022. This is when market participants really understood that inflation was a big, big problem. This is Q1 of 2022. That is in stark contrast to what we have in the present day. In the present day, it's been rising rapidly, and it's above a 20-week moving average that's on the top of the moving average stack. That's the polar opposite of January of 2022. Ratio dropped below the stack. 20-day moving average also dropped below the stack. So it's fair to say at the moment, this really doesn't look anything like this. And as always, commentary is based on the chart in front of us. If the right side of this screen starts to morph into something that looks more like this, then concerns would increase. But this is a tight cluster of moving averages that look like they're trying to turn back up after a period of 100% normal and to be expected consolidation that can occur even within the context of the strongest trends. So now we have a left shoulder, a head, and potentially a right shoulder, and our neckline would be upward sloping, which is also bullish. In the formation on the right side of the screen, the right shoulder is a lot smaller than the left shoulder. That too would be bullish. And also notice when we were completing the left shoulder here, look at the slope of the 250-day moving average. It is highly indecisive and flat. It's the dotted black line here. That's not what we have in the present day. We came back earlier in 2024 and tagged an upward sloping 250-day moving average, and now we're well above a confident looking and upward sloping 250-day, which looks nothing like January of 2022. So we can be confident about the chart in front of us. That doesn't mean we're overconfident about Monday or even the next 3 weeks. We'll see how it unfolds. It's also interesting to note, if we move back here in this area where market participants were concerned about inflation, on August 16th of 2022, President Biden signed the Inflation Reduction Act. This was a massive spending bill. And you can see market participants really did not like the massive spending bill because they were already concerned about runaway and unabated U.S. government deficits. Typically, the Fed really doesn't want to comment on congressional actions or congressional spending. This is signed into law on August 16th. 3 calendar days later, the Fed at Jackson Hole releases a white paper that basically says market participants believe that the fiscal situation in Washington is out of control. And I quote from the abstract on August 19, 2022. The recent fiscal interventions in response to the COVID pandemic have altered the private sector's belief about the fiscal framework, which is a nice way of saying market participants really don't trust the government to balance the budget or to reel in runaway spending. That was already a problem up here. It became even worse after this massive spending bill on August 16th of 2022. Here's August 16th of 2022 right here. It ignited the last leg down in the bear market in 2022. Think of it this way. Fast forward to the present day. Market participants are concerned about spending. We have a massive spending bill. We haven't been talking about deficits or balancing the budget for a long, long time, and that's both parties. When we get over here to the present day, the right shoulder, there is some talk in Washington about runaway government spending, and there is some talk to try to sincerely rein in some of that spending. That would align nicely with a breakout from this long-term period. It's not a prediction in any shape, form, or fashion. We will see how it unfolds. It's a chart that we covered last week. It's the ratio of the NASDAQ composite relative to the S&P 500 index. Here's your period here. Notice before the S&P 500 peaked in January of 2022 here, the ratio of the NASDAQ to the S&P 500 had peaked a long time ago when inflation concerns started to increase over here in that left shoulder area. And then when we had the wide adoption of inflation concerns, this ratio plummeted. Compare and contrast the look of the chart last week that looked like it was trying to make a stand near the 30, 40, and 50-week moving averages. With concerns about inflation picking up and a Fed meeting next week, does this chart have a rollover look like this, where market participants have changed their mind and now are concerned again about inflation? If we fast forward a week, the answer is no, that's not what it looks like. It looks like we have a tight cluster of moving averages, and it looks like this ratio looks better than it has for several months. Still consolidating, still needs to clear this high, but unequivocally, unquestionably, this looks a lot better than the exact same ratio in January of 2022. And we know this window in here from November 2021 to January of 2022 was followed by pain and suffering. Thus, if market participants, the chart in front of us, doesn't really seem to be overly concerned about inflation. Notice I said overly concerned. There's no question the right shoulder is increasing concerns about numerous topics, including sticky inflation. That's what a right shoulder is. You revisit some of the same issues that sparked the bear market. So the same issues that market participants are concerned about over here in the left shoulder that sparks the bear market, they're back, some of them here. So yes, concerns have increased, but the chart still seems to be leaning strongly toward the bullish side of the ledger. So let's talk now about market breadth. It has unquestionably been weak. We're going to quote from CNBC. Here's the Twitter handle source of the data. Bespoke pointed out that after more than 8 days of declining stocks outnumbering advancing stocks, the S&P 500 has seen a median gain of 12.4% in the following year. And if we know Bespoke, their N, the number of cases, is as high as they can find, meaning they probably went back as far as they could with the data. And the median gain in the S&P 500 when market breadth was unquestionably, unequivocally weak in the short run was 12.4%. What does that tell us? It tells us that taken in isolation, market breadth is not a reason to do anything other than pay closer attention. This tweet here from the founder of Sentiment Trader points out correctly that something just happened relative to market breadth that's only happened 2 other times since 1962. And a year later, ugly returns. One case, the market was down 40%. The other case, it was down 11%. There are some caveats. The first date is March 18th, 2008. If you know your market history, you know that March 18th of 2008, see the upper left-hand corner of your screen, looks nothing like November of 2024 or December of 2024. We have a full-bore bearish look almost here on this signal date, and in the present day, we have a full-bore bullish look for the most part. This is a radically different environment which produced a loss of 40% over the next 12 months. How about the second case? 7/16/2021. Longer term, this one's a little bit more concerning. However, here is the chart, 7/16/2021. This unequivocally looks more like the present day. This is a much better match. This doesn't match at all. So 12 months later, the market was down 11.5%. That's relevant, something we should put in our back pocket. There's a however coming. If we walked forward, or let's say we liquidated our entire portfolio on July 16th, 2021, would we have been happy about that? For us, the answer would have been no, because in the next 5 months, the S&P 500 gained an additional 10.84% before peaking 5 months later. So even if this case occurred in the present day, it doesn't necessarily mean we have to do anything right now. All of this is very valuable because it's pointing out facts in the present day. These are facts. They're indisputable, and it helps us keep an open mind about much worse than expected outcomes over the next 12 months. Concerns would increase if the chart in the present day starts to morph into something that looks more like a rollover look. We just don't have that in the present day, and that's true on the chart of the S&P 500 as well. Now let's take these same concepts using a weight of the evidence approach and look at a wide variety of asset classes and see how they acted when market participants started to become more concerned about inflation, and then compare and contrast them to their look on December 13th, 2024 to see what we can learn about present-day concerns about inflation relative to concerns in Q1 of 2022. Since the concepts are similar, we can move quickly. January of 2022, energy starts to outperform the S&P 500 in a big way as widespread adoption occurs relative to concerns about inflation. Rather than having the ratio make new monthly highs, we just made a new 52-week low. Same thing here. Early in 2022, market participants got defensive. If the world were about to end, you'd probably rather have your money in the US dollar than in the S&P 500, and that was the case in 2022. This really doesn't look anything like December 13th. You can see materials in the first half of 2022 moved above the moving average cluster. And notice the slope of the 250-day moving average in Q1 of 2022. It has a flattish look to it. It's not really what we have over here. Same ratio is making a new 52-week low, which really doesn't look anything like this spike in 2022. Dividend stocks were very popular during the bear market in 2022. They have a rollover tight cluster look with the moving average cluster on the same ratio turning against dividend stocks and favoring the S&P 500. This doesn't look anything like this on December 13th. We'll see how it plays out next week with an open mind. Low volatility stocks, aka lower risk stocks, for the most part, favorable in 2022, not particularly favorable in recent weeks. During Friday's session, SP low volatility, SPLV underperforming SPY by 0.24%. The ratio is currently nowhere near the high that it made during the initial scare here in September. Pretty much everything that we just said about the last chart applies to defensive staples. If you have to be in stocks during a bear market, XLP is a better place to be. Why? Because it tends to lose less. Defensive healthcare was a winner early in 2022, not what we have in the present day, and I can't emphasize enough. We're talking about what may happen over the next 3 weeks to 3 months. We're not talking about the next 3 hours of trading on Monday or the next 3 days. In this case, markets were volatile in this area. In this case, markets have been going up and down. The trend, though, has been down. The trend here flipped to up. That's what we're concerned about. That's what we're monitoring, the trend, not the daily moves. January of 2022 really doesn't look anything like December of 2024. January of 2022 really doesn't look anything like December 13th of 2024. Ditto. You can pause your video player. Same concepts apply here, chart dated December 13th. And we noted earlier that tech was out of favor between November of 2021 and October of 2022. RSP here shot up the ratio like a rocket relative to XLK and didn't stop rising until January of 2023. We do have an indecisive look over here. We haven't made a new high in this ratio in several months. Shorting small caps, very popular in 2022, not so popular in 2024. Are the riskier corners of the credit market jumping up and down and screaming something bad is about to happen? Not in the leveraged loan market. This is what risk off looks like. This is what risk off looks like in 2022. This is what December 13th of 2024 looks like. BKLN was up, green, during the session on December 13th. You can see starting in Q4 of 2021, XLP defensive stocks. That was a nice place to hide. This is the 2022 bear market. Thus far in December, mid-December, defensive XLP underperforming SPY by 1.69% and making new lows. This really doesn't look anything like this. And this really doesn't look anything like the concerning turn between June of 2007 and January of 2008. Compare the ratio relative to the blue 50-month moving average to what we have in the present day. If market participants were overly concerned about inflation, we would expect this chart to be making higher highs. That's not what we have in December of 2024. Present-day charts look fine. However, it is helpful to have a study like this to keep us from becoming complacent or overconfident. Having said that, does the look of this here pair up better with the present day? Or does this study, based on something that just happened in 2024, pair up better with the present day? You can pause your video player, read the bullet points from Dean Christians at Sentiment Trader. You can find the website here. 1 year later, best performing sector, information technology. That doesn't look anything like 2022, when tech was one of the worst performing sectors. Median return in the historical cases a year later for tech, just a hair under 20%. S&P 500 up almost 9%. Again, number one performing sector after something that just happened in the present day in the historical cases, technology. And the look of this chart here tells us we should keep an open mind about tech outperforming the equal weight S&P 500. It still has work to do, but making a lower low here relative to this low in October, and the ratio here is well below this high. When this ratio is moving in this direction, that's going against tech. When it's falling, it's favorable for tech. We're still unequivocally on the right side of this slide. The left side helps us maintain realistic expectations about how markets operate in the real world. Drawdowns, volatility, 100% normal and to be expected within the context of even the strongest bullish trends. If the charts and data start to erode, we have to be willing to acknowledge that. But that is not what we have on December 13th, 2024. And we all know the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.